I don't know if the like demand being infinite for max intelligence will ever go away. Mm-hmm. What's interesting to me is, and people use this word token maxing, I think 2026 will, among many things, be a year where companies sort of face the truth about whether token maxing is something they want to be doing or not, or at least in what capacity. My belief is like the free market will play itself out, and we're already starting to see this. And eventually, whether it's the labs themselves sort of load balancing between models, whether it's people using things like OpenRouter to actually manage as a gateway their model usage, you will find that for the average developer, the vast majority of things that they are doing day to day, whether it's like posting a PR, doing code review, I mean, a million things, many of those individual tasks do not require the latest Opus model, right? We're in this benchmark world, and many of these benchmarks are increasingly like very impressive things that suggest a whole slew of characteristics about a model, many of which are really, really important, but for people to do their day job are not highly relevant.
All right, welcome to the OK Computer Podcast. I am Dan Nathan. I'm here at FirstMark Capital's global HQ here, and I'm with partner David Waltcher. David, welcome to the podcast.
Thanks for having me.
I'm excited to do this. You and I have chatted a bunch over the last, let's call it a couple months since I've been here and gotten to know a lot of your partners here. Obviously, I go back with Rick and Amish. And what we're doing in this series is we're trying to get a sense of like the different focus that you guys all have, like different verticals and how you think they come together, where you had been as an investor pre-2022 or late 2022, and how you see that industry or those industries in general, you know, being disruptive or the sort of pivots they made. We want to talk about China and a lot of the stuff that's going on there and what the threats are over here, and maybe exits, you know, IPOs, maybe M&A. I mean, you played in infrastructure software and security, and it seems like if those companies didn't make the right pivot, at least in the public markets, the way I think about it, they've kind of just been left for dead. So maybe it's a bit of a baby with the bathwater, but maybe we're seeing some signs of life of possible M&A, whether it be strategic or from PE, that sort of thing. Let's start really quickly with your background, because you started in venture the way I think a lot of kids in college would love to start in venture as
right
an
after.
intern. Right after
Yeah.
and get going. And I hear this so much because it's such an amazing sort of field, and you guys get to do so many cool things that it doesn't look like in the public market. So let's talk a little bit about it. You're in this amazing firm, Accel. You start out as an intern. How'd that all happen, and how'd you get here at FirstMark?
Well, how'd it happen? I mean, mostly serendipity. Mm-hmm. Also different era. So like this was the late 2010s. I was literally looking on Handshake, which now is a very popular data platform that competes with like the Mercors and the Scales. But at the time, Handshake was really for 20, 21-year-olds to find internships at college. And Accel was having a, what are they called? Information session. And I just went and
there must have been like
had an interview.
Thousands of kids though who wanted that job.
You know, there were, but even 10 years ago, like it was a very different time in the venture world where, of course, it's the buy side, and you have a lot of the finance folks that would love to sort of supercharge their path into the buy side and do that out of school. But at the same time, venture was more of a cottage industry back then, right? Like I don't have the numbers off the top of my head, but like by any metric, whether it's dollars invested in the venture ecosystem, number of firms, this industry has ballooned in the last 10 years in a pretty major way.
So what you said about venture being a cottage industry, and you know, somebody who has been in the public markets from the late 90s had a front row seat for kind of the infrastructure build for the internet and all the, you know, interesting companies that were coming up, and a handful of them are still around, and they're like much bigger companies. But at the time, it really wasn't until, and there just wasn't a lot of venture money out there. I mean, just think about it, right? Yeah. But when you came into the business, we had Facebook, LinkedIn, Twitter, I'm missing a couple. That kind of changed the game a little bit. But it's interesting. They were all consumer-facing platforms, you know, that sort of thing. So was that part of the motivation? Did you see a bunch of this consumer stuff that you were using? You just mentioned Handshake. Obviously, Handshake wasn't founded probably for another 7, 8 years. I actually interviewed on this podcast, let's say a few years ago, the CEO of the company. Garrett
Lord.
Yeah. Awesome dude.
I think.
Yeah. Awesome dude. But now it's not that sort of thing. You don't go there to get interviews. You go there. It's like a data platform. Like it's like a B2C sort of thing, or no?
They are in this really interesting kind of nook and cranny of AI where they set up experts who train data for the AI labs.
Okay. Very cool.
Through specific tasks.
So, all right. That's a great example of a great pivot, right? So
awesome
Yeah,
pivot.
but let's get back to that. So okay, so you're Accel. When do you become an investor at Accel after?
Yeah, so I interned for the summer, which was a very scary experience. They basically just throw you in the fire and let you do the job as if you're a full-timer. And at the end of the summer, I was really fortunate that one of my really good friends, Christine Esserman, who's still there, and I, who were co-interns, both got offers back. And so spent my senior year of college knowing that I was moving to the Bay. And basically.
It's a lot of Smoky Joe's, basically.
What's that?
It's a lot of Smoky Joe's.
A lot of Smoky Joe's, yeah.
You go Google it, kids. So you moved to the Bay Area, you're a New Yorker, and the culture out there was what? Pre-AI, what was like the fascination?
Yeah, so like to your point about, and this is really interesting, to your point about consumer, it felt like most of the Bay Area firms at the time had really made their money on consumer, right? I mean, Accel being a great example, the Facebook investment has been very well profiled. They led the Series A there. It went public at probably 120 billion or so, and isn't
that cute? 120 billion. Yeah.
It was adorable.
Yeah, exactly.
But like even when I arrived in the venture world, we had very clearly moved to a SaaS era. Even at that time in the late 2010s, like the pendulum had pretty strongly swung towards enterprise, where it felt like for a at least 5-year stretch, there was not a ton of consumer opportunity left. And I would credit a lot of that to the fact that the big era was mobile in like the early 2010s, and that created obviously Snapchat and Instagram and WhatsApp and Facebook. But the shift to cloud, which I think was the hallmark of the late 2010s and basically up until this AI moment, really wasn't a massive tailwind for consumer in the same way. Most of these consumer apps actually have more mobile than web traffic, right? And so if you just think about like what cloud means, it's a supercharge for enterprise applications and, I'm sure everything that we're going to talk about now at the workflow layer. But yeah, and then of course, like in that COVID era, much of the market was driven by SaaS exits, whether it was at Accel, it was Slack and CrowdStrike, and for plenty of other firms, it was Snowflake and Zoom, and a very long list of names across all these different areas within the software layer. And yeah, I mean that was really interesting to me because I showed up to Accel as a history major who again like studied a little bit of engineering and entrepreneurship, but I knew the names Facebook, I knew Spotify, I knew a handful of their investments in that consumer world. It turned out like Atlassian and Qualtrics and all these names that were such hallmarks of the firm's culture and ethos were things that I had no idea about, right? Like I had no clue what Jira was. I don't know if you know what Jira is. Jira is Atlassian's main product. It's a issue tracking tool for developers. And like, that's an interesting way to start a career, right? Like being thrown in the fire, expected to invest in enterprise software, really not knowing a thing about it or any of the domain area. So my experience there was awesome. And I would say, awesome is an understatement, but importantly, like I have to credit them and the way they think about growing talent, which is for your first year, especially if you're me and you're coming out of school, you are not going to be super helpful, right? Like around the edges, you can help here or there, but really it's about like, for them, evaluating whether you have the long-term skill set and sort of like the raw materials to build your
and temperament. Let's talk about just kind of your broader thesis. At some point, like most great investors over the last few years, a switch got flipped, in your head, and everything that you knew about enterprise software. At first, when I think about 2023, every company, and Mark Benioff's a great example, he's out there just talking about how they are transforming their business, that agents is going to be the way of the future. He was kind of making fun of Microsoft with the idea of co-pilots. You remember this? It was a lot of sort of back and forth. And he's one of the legendary salespeople, obviously in just tech in general, but obviously out there he's revered. They built a big tower after him and everything like that. When you look back now and you think about just the way the stock traded in 2023, it like doubled. It was just like really one of the poster children for how AI is going to transform a lot of businesses. And then since then it went down like 65, 70% because they weren't able to do the things that he kind of envisioned, whether it was whiteboarding or that sort of thing. And you mentioned before Snowflake and Zoom Zoom, and there was a handful of others, and these were enterprise names. I mean, they went parabolic in 2021.
Yep.
They actually, in 2022, just got absolutely destroyed. The NASDAQ was down 34% at some point, and these stocks had doubled, you know what I mean, the NASDAQ to the downside. And so to me, it's just been a lot of fits and starts. You know about the SaaSpocalypse and all this sort of stuff. Just give me a sense of like how your mindset changed from investing in a lot of those companies, seeing the opportunities for companies that actually were well positioned to adopt and integrate this technology and disrupt themselves for all intents and purposes. But some of them have not been able to really come back. This is in the public markets. Let's just start there.
I think, first of all, the rate of change in AI is so fast that you commonly see, I'm not going to say overreactions, but you see very strong reactions with very little information in the public markets often. There's a good example of this like 5 months ago maybe where there's a popular, and who knows what the attribution is, right? But there was a popular series of posts going around concurrently, and maybe that was a coincidence, about somebody vibe coding. Maybe it was a customer support software tool. And all of a sudden you saw like the SaaS index just get whacked that day, right?
I remember that. Okay, so it was in fintech too, in particular. It was something, these stock.
It happens all the time.
Yeah.
Everybody loves to, we are living in this world on Twitter now where clickbait or not, like everybody's optimizing for engagement. Engagement tends to follow from very hot takes that are spicy and opinionated. And, in moments like these, like you just see a ton of them. I think common frameworks about whether software will survive tend to circle around whether these tools are actually systems of record or whether they're not. I would say like one thing is for sure, like in Salesforce's case, they're probably one of the more interesting case studies. The way in which we interact with computer interfaces is obviously changing, right? And so Salesforce is a good example. Like historically, Salesforce made its money by being a system of record, but that meant that people had to continue to input data into Salesforce and create custom fields. And out of those, fields, they generate reports that they'd run their business on, whether it was weekly pipeline meetings, QBRs, future forecasts, et cetera. Obviously, human interaction with a tool like that is going to drastically decrease, while agentic interaction with those tools is going to go up. Does that mean it becomes more or less valuable? I think you'll hear a lot of different takes on that. In Salesforce's case, we've generally seen them hold up pretty strongly as the system of record, and whether that means they can command as much of a premium from a contract size standpoint, I think is still up for debate. But many companies have not churned from Salesforce, and actually I continue to hear, if you look at core categories like CRM or HRIS or IT help desk like ServiceNow, we hear of a lot of very large AI companies who actually are signing contracts today with those sorts of companies. And whether that's an IPO readiness thing or whether it's, certain truths about a business and just the laws of physics and how organized you actually truly have to be to run a company of a certain scale, whether it's on a people basis or revenue basis, like there are a reason that these things exist. And also there are a reason that even if you can vibe code, so to speak, the front end and the way the application looks, there's so much underneath all of that. Take Salesforce, for example. Salesforce has one of the richest partner ecosystems, and that applies to both like plugins into the app as well as partners that can help companies build custom Salesforce instances and all of these different things. Like whether or not I could vibe code a CRM has actually very little to do with whether I could duplicate that business, right? I'd say maybe the last thing is like Salesforce is built on trust. There are companies out there that have decade-plus long relationships with the Salesforce team, and that's something that's very hard to duplicate too. So I in general, yes, I am largely bearish on the application layer. I also think that a lot of these companies are going to be more durable than many in the public market think, and that there's probably going to be some level of like have and have not that is contingent on ability to adapt, existing entrenchment, and switching costs, right? Which is sort of like a normal software
That's where I was going to
paradigm.
go. I mean, can you imagine like the length in which or the extent in which you would have to go down parallel paths if you were really building your own, like, I mean, it would just be, especially if you're a mission critical, working with very highly regulated industries, that sort of thing. So again, I think that is something that I think was underappreciated by a lot of public market investors because they're looking at this sort of hockey stick growth. I mean, think about Anthropic and the way in which revenues are growing there. And I think a lot of these kind of SaaS companies companies, they have seen obviously, high single digits, like maybe 11, 12% growth. And that's not that exciting. And these companies were not particularly cheap, not trading below market multiples, that sort of thing. But I do think it's interesting. Last week, it was Silver Lake maybe and somebody else kicking the tires around Workday.
Yeah.
And this is, again, I think it's like a $45 billion market cap company.
Yeah.
I suspect, so obviously that's a financial buyer. I have to think there's some strategic things out there. And I wonder if you're going to start seeing, some of these big labs. Like, for instance, if you're OpenAI and you are lagging behind Anthropic in the enterprise in a big, big way, might you buy, some existing sort of legacy-ish enterprise software company to get that customer base or something like that? Because, and I'm just throwing that out there. I mean, PE probably sees lots of opportunities here, and that might be a theme for, let's say, the back half of this year.
Yeah.
I'm just thinking, so how are you thinking about just M&A in general? And any examples you want to use of your portfolio companies?
Yeah.
Yeah.
I mean, Momentum is a great example.
Yeah.
Like Salesforce bought one of actually the first company that I invested in here at FirstMark, Momentum. Momentum is literally the use case that I described.
Mm-hmm.
They synthesize and take notes out of live meetings that you have, and they put them into Salesforce for you, among many other places. But that's a really, really important use case for a company like Salesforce to figure out in a world where, people are no longer going to be spending 2 hours a day inputting data manually into a tool like Salesforce. So Salesforce, if they want to survive, right, they have to be the system of record. They have to have all the data about who my salespeople are talking to, what contracts they're talking about, how long those contracts are, all those things, right? But in a world where, that same rep is using 20 AI tools, to expect them to spend those 2 hours a day or whatever it is in Salesforce is quite a lot, right? And so that's the opportunity. I think M&A is really interesting right now. And I mean, there have been a bunch of acquisitions in the last probably 2 weeks or so that have been notable and interesting. Stripe buying OpenRouter.
All right, so the OpenRouter raised in May at $1.3 billion, and it just got bought for $7 billion. Now, for me, who's somebody who stares at FactSet machines all day long, and I've been doing that for like 25 years, like to see that sort of premium paid for anything is insane, right? So just like help me think about that on the M&A front, the Workday deal, because it's been around a long, I mean, like it might get a 20% premium and that will still be 40% lower than its all-time high. So you as an investor, any of your companies get 5, 6x like that in a short period of time, you're happy as, but like, what does that like say to you? Like that this is the environment that we're in.
Look, the market is just growing super fast. Like the financial profiles that we are seeing across infrastructure, across AI applications, they just look nothing like what we were accustomed to, right? And I think a common trope that you'll hear from investors is that like people have had to readjust their priors on metrics. Mm-hmm. One of those metrics is definitely growth rate, right? What's also interesting in the M&A market is, you have opportunistic buyers like Silver Lake who will find assets like Workday that maybe they like more than the market does. You'll find buyers like Stripe who are really, really interesting businesses that have probably AI strategies that they're working on, but I wouldn't say they're AI native companies, but they can still acquire companies from a position of strength, and OpenRouter is a great example of that. And then also, even though the space has been, in truth, probably around for, call it 3 years or so, AI, the new buyers in this space are already so large, right, that you can afford pretty large outcomes in the M&A markets. And so, whether that's OpenAI, whether that's Anthropic, obviously SpaceX is not a new company, but $60 billion for Cursor. We're seeing like the hyperscalers get more aggressive than ever. We're seeing companies like Datadog get very aggressive on the M&A side. So I think, it's just the perfect confluence of a few different things, which is volatility in the public markets that creates interesting opportunities occasionally, like Workday. Well-funded companies from the previous era who have sort of figured out their AI strategy and are willing to make splashy purchases like Stripe and OpenRouter. And then just this massive new wave of buyers that are very well capitalized and that are very aggressive and that are running, often it seems like 4 or 5 strategies at once, who will play aggressively when they're looking at an asset they're excited about. And so, that is, I think, the general synopsis of what we're seeing in the M&A markets. OpenRouter is like a fascinating company because it plays on so many different trends, right? Which is, I'm sure you'd love to talk about Chinese models, open source models, like or I'd say the increasing level of choice that users now have on the model side and what that implies for a whole variety of different facets of this industry, whether it's the large labs, whether it's companies like Apple who are trying to work on the ability to run these things locally, whether it's inference players who mostly are getting their volume from open source or Chinese models. So yeah, like OpenRouter is a fascinating company.
Yeah, it's interesting what you just mentioned, though, going back to momentum for a second. It's like, I look at a company like Zoom and I say to myself, it's got an amazing balance sheet. They have a huge installed base. I'll bet the kind of switching, once your business is on that, you kind of stick to it. And, Google Meets and some of the stuff like the Microsoft Teams, they kind of suck, you know what I mean, for all intents and purposes. And I just think that that's one, I think they're trading at like 2x cash or something like that. There's no debt. Like that company's going to get bought. I mean, like just like matter of fact. So we should all go out and buy it. I don't own it. Let's go to these Chinese models. And so open source, open weight, obviously, everyone's learning that you already knew this, but they're two different things. When you're talking about inference and you're talking about companies, let's just say, are building, these native AI platforms, yes, they were getting destroyed. There was token maxing, and now it's a la carte, and it was getting very expensive. And now all of a sudden, let's go back to January of 2025, DeepSeek, and you see where they are, what it took to do it, the gap between our models and theirs. And now it's Alibaba, so we have Kimi, we have Quen, the list goes on, and we keep seeing the gaps getting narrower and narrower. And then if you think about like Microsoft Copilot, they added DeepSeek's reasoning model, right? I'm sure they're looking at a lot of different models, and the cheaper they are, the more uptake they're going to get of them, right? And so Copilot's a great example where I think there's like 450 million Office 365 users on the planet, and they have basically converted like 20 million so far. So for them, if you can put a lot of these cheaper models on there, and you're going to give your customers a lot more choice and cheaper choice, right?
And you're bundling it anyways,
Yes.
so it's in your best interest to keep it.
And they want to stick it to OpenAI at this point, right? Like
it's
Microsoft too. Like, so help me think about that.
I mean, this market is so interesting because on the one hand, like frontier models, which are large, they tend to be cloud hosted. I don't know if the like demand being infinite for max intelligence will ever go away, right? Like we'll see. But every time a frontier lab launches a new model that is best in class at X, Y, or Z, it seems like the demand is largely infinite. And I'm being somewhat hyperbolic, but I think that will remain true in a lot of ways. What's interesting to me is, and people use this word token maxing, I think 2026 will, among many things, be a year where companies sort of face the truth about whether token maxing is something they want to be doing or not, or at least in what capacity. What's interesting to me is a lot of those same companies that have been token maxing. Let's use the CodeGen example. These were not companies that were paying 100 percentile salaries for engineers, right? Many of them. Some of them were. But let's say the ones that weren't, let's say they were companies that were paying 50th or 60th percentile for engineers. Why are they paying 100th percentile for tokens? Why are they using the most expensive, biggest and best models for a variety of tasks, some of which actually don't require that level of intelligence? My belief is like the free market will play itself out, and we're already starting to see this. And eventually, whether it's the labs themselves sort of load balancing between models, whether it's people using things like OpenRouter to actually manage as a gateway their model usage, you will find that for the average developer, the vast majority of things that they are doing day to day, whether it's like posting a PR, doing code review, the million things, many of those individual tasks do not require the latest Opus model, right? And so like OpenRouter is interesting for that reason, and they do a couple of other things, but like if you just think about this general world of model routing and model gateways, these are the things that are enabling people in real time to almost load balance and dynamically route tasks to certain models based on what those tasks are. If you look, I think it's in February of 2026, so earlier this year, there was a moment where you can look on OpenRouter, the percentage of tokens that are flowing through open and closed models. Something really, really shifted right when it was GLM, Minimax, Kimi, Quen. I think it was roughly 60-40 closed open, and it completely flipped. And the open models had this moment. Yeah, it was just watching capitalism play out in real time, right? Where like these models were basically 1/20th of the token cost per million tokens. And they were highly performant at a lot of the things that people do in their everyday, right? And so, yeah, it's interesting. Like we're in this benchmark world, and many of these benchmarks are increasingly like very impressive things that suggest a whole slew of characteristics about a model, many of which are really, really important, but for people to do their day job are not highly relevant. Yeah, it will be fascinating to watch how this plays out.
But that moment that you just talked about, which it wasn't that long ago. It was in this kind of moment of token maxing. And, it's funny to me because it went from this thing where I read there was a handful of companies, there was probably dozens or hundreds, where they had like leaderboards, like folks who were using the most tokens, that sort of thing. And, at the time, like the major labs were like, hold on, we got to pull back on this thing. But when you think about, like, let's say the latest Opus that just came out from OpenAI, they've already dropped the pricing like down 70% or something like that. So the Chinese open source models are causing a price war here. And so when you think about these companies readying themselves for IPO, and this is obviously Anthropic and then OpenAI, this could cause a huge problem, for them, if you think about it this way. Now, that whole idea of Jevons paradox, the cheaper the tokens become, the more usage you're going to get, that sort of thing. But if you're telling me that a lot of these sort of jobs that need to be done don't need, the latest model or that sort of thing, you start saying to yourself, okay, these are all going to become commoditized, right? And the Chinese models, we know that, for instance, the development of them, they have the cheapest cost of capital, labor, energy. They have the backing of their government.
Their grid is growing much faster than ours in the US.
So the energy thing is huge, right? And then you think about that, and you think about them innovating, making do with less, okay? So they couldn't get the latest, Blackwell right now. So they're using CPO clusters. They're using lesser sort of less power intensive sort of chips. Their memory, all of a sudden, Apple wants to use CXMT. Now our government's not going to let them use it because they can't get access to high bandwidth memory and DRAM, that sort of thing. And then it's the models. And then all of a sudden you say to yourself, they're closing the gap. Alibaba guided for the next 3 years for CapEx, $56 billion. Our companies, the 4 hyperscalers, are going to spend $800 billion this year and then like $1.5 trillion next year. I mean, it's insane. So like, how do you think about China the way they're coming on now? Do they have the ability? I mean, I look at, you keep hearing about a bubble and misallocation of, resources, that sort of thing. China could do that. They could flip this thing on its head and we could end up like, we're all going for AGI here. The Chinese might get there first. And then you're going to say, what did we just spend trillions of dollars for?
I think all of the things going into like how quickly can we get there? How quickly does China get there? Who plays in what turf? That's all really interesting stuff. The most valuable companies in the broader AI universe are American-based, and that will be true for, I think, quite some time.
Well, so let me ask you this. So in different verticals, is it going to be like a winner take all? So just think of past cycles, Microsoft owns operating systems.
Sure.
Amazon owns e-commerce, right? Google owns search. Meta owns social media for all intents and purposes, right?
Yeah.
So if you think about those individually, I know it sounds kind of goofy to say, yeah, Claude is going to run away with enterprise. They're going to be the Microsoft of, enterprise, and maybe OpenAI looks like Facebook/Meta or whatever, Is there risk to that? And does it kind of squash innovation because where you play is like, earlier stage, right? And I'm just curious how you're seeing that because you have these behemoths, they generate a shit ton of cash flow. They have these huge balance sheets.
Yeah.
They can raise unlimited amounts of money in equity and debt. What does that mean if like you're not, if there's not this M&A cycle, which you probably would be hoping on, because how do you create the next 100 billion, 200 billion, valuation company?
I don't think this is going to be a winner take all market. I even think like comments about Anthropic being the enterprise winner and OpenAI being the consumer winner are a bit lazy. Like if you looked at the Codex numbers, for example, they're pretty astounding too. I think both companies are doing phenomenally well. And it's just a question of like at any given point in time, based on the latest model, the latest product, which one seems to have more momentum in which sector and why. The way I think about this world is, especially in the world of applied AI, when you actually get to the application layer and you look at all the great companies that are building agent harnesses, whether it's, just to name a few companies in the FirstMark portfolio, like Legora in legal, or whether it's Nebulock in threat hunting. Like in many cases, they are relying on some of these frontier labs for their models. And in many cases, like they're building real stuff around those models that is proprietary. And that is like very classically how technology companies build, right? They rely on for as long as tech has existed, if you looked at how much open source software, for example, that the average enterprise business was built on, you'd say you'd really have questions about IP, right? It just happens to be that these things are licensed to be open, and that's that. Same is true of cloud, right? Like I credit OpenAI and Anthropic for building really canonical building blocks for how people think about building companies today. But this question about like, will Anthropic eat the enterprise world? I think it's just too vast and too specific for them to have sort of that like 100% market share in all these different categories. And I don't see that being the route that specific markets are going to go down. I can't speak to every, but certainly where I invest, security, developer tooling, like there's just so much opportunity outside of the core workflow that you see out of the labs. And look, maybe that will change or it will steer itself in a different direction. But right now there is a rising tide that seems to be lifting all boats, right?
All right, so let's talk, this is obviously in your wheelhouse on the security front. These are legacy companies, and it seems like some of them have made some of the best pivots, you know what I mean, within the software ecosystem. Yeah. And I love, to kind of, you explain to me a little bit, because this seems like sci-fi shit. Like what happened with this Hugging Face breach, right, is like, these OpenAI, they're doing this evaluation, right, of these models in a sandbox, and they weren't meant to like get outside of that, but they found ways around it. The agents were working together. Then OpenAI recognizes a certain part of this. They shut a bit of it down. Yep. One of the agents or a couple of the agents are leaving notes for the other, you know what I mean? Yeah. So like it's crazy shit. And then they literally hacked into one of, you could say that Hugging Face is one of the most important depositories of models out there. Like this could have gone absolutely haywire. It seems like Hugging Face had no idea what was going on. OpenAI finally figured it out, but they were very quiet about it. Yeah. And then they had to come out with it. Like, without maybe, did I explain that maybe reasonably well?
Yeah,
okay. Enough. But it seems like crazy to me that all happened. So from a security standpoint, I mean, this just seems like so much opportunity.
Yeah. Like look at CrowdStrike and Palo. Look at their performance in the public markets. I would not call either a legacy business, but these are winners of the SaaS era who are now winners of the AI era. And I think security is a really interesting sector right now in AI, because we're seeing things like the Hugging Face OpenAI incident on a weekly basis. Yeah. And it is terrifying.
Well, then Anthropic had one right afterwards,
right? It's terrifying. Yeah, like in security, the entire paradigm has shifted. I mean, there's so many metrics by which you can measure this, but I would say the cleanest way to measure this is just like, obviously the number of vulnerabilities has ballooned, and also just everything's becoming a 0 day. And so what that basically means is like, if there's a vulnerability posted, how long does it take for that to become exploitable? Like anything that could affect your company right now from a security standpoint, you should be worried about like yesterday. And that's generally speaking impossible for a security team to fight off. Like it's just too many things, right? Like that's not how security teams historically have worked. And so, yeah, I think this is why you're seeing companies like CrowdStrike and companies like Palo, and of course, like all of these really interesting startups that are, if you think about like what they're doing, they're basically saying, look, attackers, hackers, they have access to these models. These models are very powerful, as we see. So do we. Can we build something better than these people that can either defend, prevent, mitigate, whatever it is, right? And you see a slew of different options across all the security vendors in the world. But can we build something better that like serves you more as a potential recipient of a really nasty attack? Like I think some people will refer to security as like an insurance industry. Increasingly, it's not. Like the levels of activity that we're seeing across endpoints, across cloud services, across general like firewalls, it is beyond scary. And so, yeah, like that's where I've spent a lot of my time, I'd say in the last year or so. My last 3 investments have all been security investments.
So explain a little bit what attracts you to these companies and what are they doing? What are they building that seems very unique relative to, let's say, CrowdStrike, Palo Alto, that sort of thing?
So both CrowdStrike and Palo Alto started at really important points in called like the security chain. Palo was historically a firewall company. CrowdStrike was historically an endpoint company. Endpoint is just like the fancy way to refer to devices, so laptops, mobile phones, et cetera. Both played on very important trends, right? Like rise of the internet in Palo's case, and then in CrowdStrike's case, like personal laptops and mobile devices now being like part of the quote unquote security perimeter and what that implied for companies. But to be clear, like both companies now basically do everything under the sun from a security standpoint. My last investment was a company called Onyx Security. Onyx is the leader in agent security. Agents are a fascinating like vulnerability, you could call it, in the security chain. Because if you think about what an agent is, like there's actually very little, whether it's cloud code or whether, I mean, any agent really, right? Like operates completely stochastically. So even if I said, you know, hey agent, like make sure you don't delete my production database. Stuff happens, right? Yeah, I mean, that's probably like the most rudimentary possible example, but we are seeing agent activity that can be very, very nasty for companies all over. And so what Onyx does, for example, is first of all, just actually inventories all of your agents as a CISO. So, you know, maybe you have O365 and you assume everybody has Copilot. But like, what about the 10 other tools that everybody seems to have that you didn't know about? What do they have access to? What can they do? Where are these agents running? What resources are they touching? And then 2, they actually let you build like semantic guardrails around what those agents can and can't do, which is super, super important because all of a sudden now you're basically having these like supercharged humans that can work a computer way faster than humans could, that have credentials and access to systems that even their core users and the people that provision them in the first place have no idea about. And there need to be guardrails in place. And that's a very hard technical problem. Mostly that exists at the runtime layer, which is basically like the execution layer. So that's Onyx. The other company that I recently invested in is called Nebulock. They're building an agentic threat hunting platform. Again, like threat hunting, there's really cool kind of sci-fi subcategory of security where experts that are called threat hunters, sounds like something out of the Terminator or something, are basically hunting for security threats within their organization. Why is this so important now? Well, first of all, historically, this is a thing that only humans could really do. Some companies would outsource this to third parties, similar to like pen testing or you know, offensive security. And Damien, the founder, incredible security entrepreneur, has hired an elite team of threat hunters who are basically acting as like the reinforcement learning engine who's training our agents. And we can now offer this via an agent to any company under the sun. And why is threat hunting so important now? Well, you know, most of our alert detection systems are just not catching things or not catching enough, right? A lot of things are slipping through the cracks. And so the whole idea of threat hunting to me is like the holy grail of security, which is like, you don't need to know what you're looking for. You don't need to be reacting to alerts that you're not sure are comprehensive. Like we are just catching stuff on an ongoing basis and turning those into detections. And then one other investment, and Andy, the founder, would probably not like me saying this, but it's sort of like a cynical view on the world. This company called Tracebit that's pioneering what we're calling the assume breach mindset, which is basically, you know, historically, like the last wave of security was very much zero trust. Set up your security infrastructure in a way that implies that you trust nobody. So anytime somebody accesses the system, they have to authenticate, they have to prove their identity. Strong, but like has failed in a lot of ways. Something like 95% of breaches now are credentialed. So, you know, we inherently trust people that have passwords and tokens and keys to things, but still we're getting breached. Tracebit is building sort of the deception honeypot, what are called canaries, platform for the modern organization that accepts the fact that they will likely be breached at some point and wants to answer the question, like, how fast can we respond? What can we learn from this? That's like the very simple explanation. So that's where I've been investing my time. I'm very bullish on all things security. I think the public markets have over the last few months and quarters, and we'll continue to see like a lot of really interesting case studies of companies that can harness this stuff quite well. And again, it goes back to the thing we were talking about earlier, like distribution, trust with customers. If you look at CrowdStrike and Palo, like the resources they are touching and owning on behalf of their customers are significant, to say the least, right? So like, if they can offer something really compelling in AI security, like there are going to be a long line of people that are very excited to buy that solution, right? And that's just how business works.
And by the company and by actually the talent. I mean, that's one of the other things, and I know you're seeing this, especially investing, you know, in seed and Series A, that sort of thing. I mean, you know, all these brilliant people are leaving the big labs and they're not having a hard time raising money, and they're doing stuff that maybe wasn't on the radar of the company that they had just left. I have to think that companies like Cisco and, the whole host of like legacy companies that have made big acquisitions in the past in security and the like, they're just going to have to gobble up these teams because they probably don't have the talent internally. Does that make some sense or no?
Don't have the talent or maybe just like need some of the new blood, right? Like it's a different paradigm. Like to build Nebulock, for example, is such a different motion from a product building standpoint than like historically what building a security company looked like. That's a very specific example, right? They're building an agent and everything that implies. And of course, they're still building a lot of stuff that looks historically like a security tool. I would say those three businesses, CrowdStrike, Palo, Cisco, and if you just think about how large Google and Microsoft security arms are.
Google just made a $32 billion acquisition of Wiz. I mean, like think about that. And that's in the security space.
There's a reason security has been one of the most active M&A markets for as long as it's existed, right? And also many of these private M&A transactions just tend to be richer from a multiple standpoint than their counterparts in infrastructure or software. And so, 100%, I think we're going to see a lot of consolidation.
All right, last question.
Sure.
What do you think derails the pace of innovation, the pace of capital that's moving into the space? And again, we just talked about a lot of trends that are huge tailwinds, but there are also certain things that need to be achieved, right? No one's going to have a definition of what AGI is, but one of these big labs is going to say, hey, we got here, that sort of thing. That's going to come sooner or later. But what if you had to push out? What if it's like an Elon Musk company in a way where you're making these grandiose sort of, predictions about things. And, every year we're going to say it's a year off or, that sort of thing. And you're already seeing that. Sam Altman and Dario, they're doing a lot of this. Obviously, Elon's doing the same thing. What do you think the thing is that kind of taps the brakes a little bit on all the excitement right now?
I mean, look, the obvious thing is like, if the public markets face a major crash or if we end up in a recession, like always there are going to be downstream effects on the venture markets. That's just how it works, right? For a variety of reasons.
And
like
usually there's
LPs
a bit
have
of
to
a lag.
rebalance their portfolios because their publics now look 30% lower and smaller than they did before. So now comparatively venture looks really big, and so they stop making new investments into funds like ours. But look, like on this AGI point, I have like more of a realist take, which is, look, everybody seems to have a different version of what AGI even means. I think if the world froze today from an innovation standpoint, there would be so much value still to be created in AI. Like we're just so early on the adoption curve, and even in its current iteration in terms of what is possible, there's just seems to be endless amounts of opportunities. So we could have like a philosophical conversation about AGI, its implications. Does that actually mean more innovation? Does it mean less? Who knows? I still think as long as we are on the trajectory that we are on, which looks like model improvement across cost, speed, performance, capability, you are just going to see a massive super cycle like the one that we're in. And whether that applies to the public markets or not, I'm more referring just to company creation, what's possible, value creation, and the like. And, like all things, you have early adopters. If you go to the Valley, like you will certainly meet people that feel like they are living in the future comparatively. And then you have the rest of the adoption curve, which I'd say like we are very early on. And whether it's industries, geographies, like this wave will disperse and spread out to the rest of the world if it hasn't already, and we're just quite early on.
Well, let's do this. I love this conversation. When you have a couple of your portfolio companies reach certain milestones that they're tracking to, I'd love to come back and kind of take a look back and on the timing of that and how kind of their perspective changes a little bit, what their customer adoption is of those sorts of things, and we'll kind of hit some of the sort of key milestones that they laid out. So listen, David, I really appreciate you being here. Thanks so much. Thank you. Cool.
This podcast is for informational purposes only. All opinions expressed by me, Dan Nathan, Guy Adami, and any other participants are solely our opinions and should not be relied upon for specific investment decisions.